Right. So I think we can start now. So good morning, everyone. Welcome to this webinar, which is going to be focusing on trading into the EU in 2026 and on regime 42, VAT risks, and what to do now. We're here today with one of our partners, Alessio Lencioni from VAT. He's going to do a presentation on the topic. But before we start, I'm just going to do a brief introduction about the chamber. My name is Giulia Bonanni. I'm one of the international trade and customs advisors here at the chamber. The Greater Manchester Chamber of Commerce is actually the largest accredited chamber in the northwest of England. We were founded in 1794, and we cover around 10 local authorities, which are the one listed here. We have around 4,200 members, which space from different sectors and of different size. And among those, around 3,000 of them are importers and exporters that we help in their international trade journey. We work through a network of connections. We have more than 680 connections, more than 50 partnerships, which include overseas chambers, but also private partners like VAT that help us and help our members and non-members in achieving their goals in international trade. Um, we were selected. We were selected as a multi-award winning chamber. We were selected as Chamber of the Year, Excellence in International Services, and Campaign of the Year. And we tend to provide a world-class support in different areas, which might space from policy and representation, research, business support, and so on. We're very active in terms of training and events. We host and run more than 200 events annually, which might be the White Chamber events focusing on different sectors like manufacturing, property and constructions, engineering, and so on. And then we have international trade focused events like trade forums and webinars like this one, which might just help companies in understanding better any changes, upcoming changes, or anything in particular related to different countries, areas, or continents. And as I said, like these events are run by the main chamber, but also in partnership with our partners in some cases. And in terms of the international trade support that we provide, we help companies with market entry services. So in case your company is looking to expand overseas or to find partners, distributors in a particular country or region, then we can help you doing that through the network of connections that I mentioned before. We also provide training courses. They might space from basic import and export training courses, but also more in-depth topics like Incoterms, rules of origin. We also provide bespoke training courses, which are tailored to what companies require. And most of our training courses are accredited by the British Chamber of Commerce. We help companies with compliance as well. So we kind of say with rules of origin, tariff classification, IPR and OPR registrations, and anything related to export controls and VAT. We have an export documentation team, which is dedicated to completing export documents like certificate of origin, UR1s, ATA carnets, but they also liaise with legalization, apostille, and notarization services. We are also a customs broker, so we complete import and export clearances. We can help with IPAS registration, GVMS transits, and so much more. And we assist our companies also in with getting paid services, which might include letters of credits, credit checks, foreign exchange services, and so much more. You can find a list of all the services on our website and a list of all the events and training courses coming up on our website. In terms of other supports, obviously you have the resources online. We have a trade hub where you will find the recording of this webinar as well, and all the recording of previous webinars, as well as slides for events that we had in the past. And we also introduced a US Tariff Resource Hub, where you can find the latest update on US tariffs and changes, upcoming changes in the US. So I'm now gonna let Alessio crack on with his presentation. So I'll just stop sharing. Alessio, let me know if you can share, and it's all good.
Thank you. Let me know once you can see my screen.
Yeah, we can.
So thank you, Julia. Thank you for the introduction, and it's a pleasure to meet you all. So as mentioned, my name is Alessio Liccioni, and I am from a company by the name of VAT Stream. I head up our supply chain and product teams, and we are a global leader in many ways of VAT management and recovery, and our specialization is coupling that with supply chain and logistics and helping business enter into new markets. One of those key markets for many UK businesses is naturally the European Union. And our job, in many ways, and why we work so closely with the Manchester Chamber, is to help businesses navigate the international tax and specifically VAT regulations that surround the European Union when entering into the market. And today, what we'll be speaking about is largely some of the changes that we've seen coming into 2026 that are ramifications off the back end of 2025. And in many ways, a lot of these are still ramifications as well of the back end of Brexit, which feels so long ago, but we're still seeing the knock-on effects now. And a lot of the VAT changes decided upon in 2025 and coming into 2026 are still alignments off the back end of that process. So today we'll look at everything from a practical and real-world example. I just believe that's easier for everyone to sink their teeth into, and it's easier to then also draw comparisons to one's own business without speaking overly hypothetically about anything. So in terms of our contents, I want to start off with looking at the context of the introduction to import VAT. I think a lot of people know what it is, but no one necessarily understands it intrinsically. So we'll do a high-level overview on that. Then we will also look at some practical real-world export scenarios and how practically things have worked and how they can potentially work going forward, as well as one of the key differences in terms of how businesses handle B2B sales and B2Cs. And then our second last point will be about the key changes that we've seen this year, specifically around topics such as Regime 42 and some other interesting information that has come about over the last week or so with regards to duty charges for parcel shipments going into Europe. And basically, we'll sum this all up as the context of the key risk areas and how to reduce one's exposure. So now, when we look at foreign import VAT, I think it's important to recognize that whenever an item moves out of the UK and specifically moves into Europe, there will always be an import VAT component in some way, shape, or form that needs to be applied. Now, when we speak about import VAT, it's a tax that's applied to goods when they're imported into a foreign country, in this case, the EU. So it's important to understand that there's also a sales VAT component that's charged when you're selling goods to an end consumer in the EU. Now, what makes this especially complicated for UK businesses doing business in Europe is that you basically have to account for both, whether you're making a B2B sale or a B2C sale. But it's an important distinction to know that VAT is ultimately borne by the end customer, and that end customer has to be a private individual, so not necessarily a business. Businesses act as that VAT collector on the behalf of tax authorities. So the long and short of it is that when goods cross a border, VAT rules change significantly. And that's a large part of what we will speak about today. So since Brexit, the VAT system for the UK selling into the EU has become significantly more complex. When the UK was part of the EU, we were part of that single market, which meant that goods could flow freely and no import VAT was being charged at the border. But now goods that are entering the EU are considered imports, which means VAT has to be applied at the border. So it's no longer considered an intra-EU movement. So this requires the fact that customs declarations need to be made. They've become fully mandatory when importing goods into Europe. Now, I know many of you might understand this and might already know this, but the reason why I'm rehashing this is because these rules are rigid, and VAT is not a hidden cost or a sunken cost into one's shipments. It's something that is there and needs to be clearly defined. And the reason why I say that, because there's a responsibility to not only your client that you're selling it to in Europe, because if it's not disclosed and fully outlined, it makes it very hard for them to also incorporate it into their own filings, which makes the whole notion of doing business together a lot more difficult. So VAT is no longer automatic or invisible when selling to EU customers. It's something that it needs to be accounted for, basically in every single way. So how does EU VAT apply to UK businesses? So we've touched on this basically, but there's a couple scenarios where this can be applied. And the first is when goods are imported into the EU, there's import VAT that can be applied. Then when goods are stored in the EU, most European countries have a minimum threshold that if you store goods and you are still the legal owner of said goods, you have to register for VAT in order to maintain a certain degree of compliance. Then there's also the requirement when goods or services are sold in the EU, you have to charge sales VAT. If you're acting as the importer of record, you incur the cost of the import VAT. And if you're selling goods DDP into Europe, there's often a requirement for you to facilitate the application of sales VAT, whether you're selling it on a B2B perspective or a B2C perspective, depending on how you've structured the import. But even without a physical presence in Europe, UK businesses still have VAT obligations to a certain degree, depending on how your transaction has been structured. So if we look at this practically, the import VAT rate changes depending on the country of entry that you have chosen to import your goods into. So if we look at the small example over here, if you take a 100,000 euro shipment value of goods, so the value of goods inside the set box cost 100,000 euros, and there's a 21% import VAT rate charged from exports going from the UK to the Netherlands, 21,000 euros becomes a payable upfront VAT cost. So that is the import VAT cost of importing those goods from the UK to the Netherlands, because the Netherlands has a 21% VAT rate. So this fee is usually payable at the customs clearance point. So it's dependent on the Incoterm, but if you deliver something on a DDP basis, so deliver duty paid, which means that all taxes and duties are included in the price exhibited by your freight forwarder, your broker, or your courier provider, means that once the goods get to the border, your broker will hand over that money that you've already paid. DAP means that once the goods arrive, a broker needs to be appointed, and whoever is acting as the importer needs to pay over those import VAT fees before the actual item will be cleared for free circulation within the country. So, as you can imagine, paying import VAT can create quite a significant cash flow impact on businesses. When you're outlaying 21% of the value of goods as working expenditure to actually get your goods into market, it can be quite onerous on many businesses. So without planning, VAT can become a cost and not necessarily a recoverable tax. And that's an important distinction, because wherever VAT is paid, in 99% of instances, it is always recoverable. But you need to have the correct structures in place in order for it to be recoverable. So now we speak about the context of who is responsible for that. And it's all dependent on the Incoterm. And I'll keep the context of what we're speaking about simple here, because I imagine many businesses that have tuned in today onto this webinar are more interested in a DDP solution. So if you are facilitating a DDP solution, and you are not acting as the importer of record, meaning your customers acting as the importer of record, but you charging the import VAT or paying for the import VAT while you in the UK. Basically, the importer of record is the only one that is able to recover that import VAT that has been charged to the shipment. It's not recoverable by you, the person paying for it. The only way import VAT becomes recoverable is if you have the correct customs regime in place. So what that ultimately means is that you've got the correct local VAT registration. That's something that we help many businesses get set up, and that you've been able to act as the importer of record. Many businesses believe that it's fine, I'm paying my courier and they pay it over, without the realization and context that they can actually claim it back. And it's also another distinction to remember that couriers are just there to clear goods. It's their job to make sure that the package gets through customs as quick as possible. They do not take any liability for VAT. And that's another very important distinction to remind ourselves about. So there are compliant ways to manage EU VAT. The first is with the utilization of a VAT deferment mechanism, which is basically a very similar principle as to what PVA is in the UK. So whereby at customs clearance, if you've got a VAT deferment in place, you don't have to ultimately pay that import VAT. It gets deferred relative to a security deposit that you've got in place with the Dutch tax office in the scenario that we've been speaking about. Utilizing the correct customs regime. So what that means is certain countries make this process easier. So the favored route by many UK businesses is via the Netherlands or via France. Certain countries don't allow for foreign businesses to act as the importer of record, which then doesn't allow you to recover the import VAT. And some countries like that include Italy, Germany, Austria, just to name a few. So by routing your goods through the correct market, that does help you optimize this solution. And that kind of links back to the improper structures. So in order to make this whole system work, you need the correct importer structure in place. So you need to be able to link a foreign importer's code in Europe to a foreign VAT registration. Those two need to be the same. And when we speak about Regime 42 in a short while, you'll understand why those two need to link. And then the last 2 points are quite self-explanatory, but having a centralized VAT reporting tool that links to all your documentation and your registrations takes a lot of pressure off you as the UK business, because you can centralize all of your foreign VAT reporting preparation that links through to your customs clearance documents, your sales invoices, as well as your import invoices. And the matching of all those independently from your business and having it all sit in one centralized place is a feature that we've seen many businesses succeed with. Because I think we live in a world where a lot of manual tasks and onerous tasks are being automated, and this is something that's no different. So I would say the key is to plan before any of your shipments move, because if you don't have the correct structure in place, it makes it either virtually impossible or a lot tougher to recover that import VAT. So if we look at a very quick practical example, we'll see this company by the name of Nova Strength. So Nova Strength imports quite a bit of a differentiation of gym equipment from the UK into the EU. And if we sit on a nominal value again of 100,000 euros in being imported into the Netherlands at a 21% VAT rate, we see that their import VAT exposure is 21,000 euros. Now, ultimately, this is tied up for at least 3 to 4 months. So if it's not paid immediately, there's clearance delays, meaning that your client doesn't receive the items when they expect to, which has a whole lot of disastrous knock-on effects. And ultimately, when there are those delays and you aren't able to recover that import VAT quickly, it does firstly become a cash flow burden, but secondarily, it also increases your landed costs and administrative burden, but in a way that doesn't allow you to forecast it successfully. Because you're never entirely sure of what it's going to be. There's always an element of moving these goods in that's going to be bit of a thumbs up and a prayer. So the solution that we've implemented for many businesses revolves around specific customs treatment. So we structure it with a correct importer structure. So what we do here is we actually get the UK business set up with something called an EORI. So many UK businesses will be familiar with a UK EORI. You get something called a European EORI or a Dutch EORI, which works in a very similar instance to your UK EORI, but it is basically your importer's identification number across the whole of the European Union. And what we would do there is that it's linked directly to the UK business. So it doesn't require you to have a local entity in Europe or anything to that effect. But basically, with that registration, it allows us to then register the business for VAT and a VAT deferment. You have to do you have to do the VAT registration before you can do the deferment mechanism registration. And once those three aspects are linked, we call it our VAT deferment toolbox. By having that toolbox in place, it allows the import VAT not to be paid up front at the border. So the VAT is declared and reclaimed on the same VAT return. So what that ultimately means is that it's looked as a pass-through cost. The Dutch tax office is saying, we know this business, we understand this business. All their imports are going to be for resale use. So there's no point in getting them to pay over the 21% VAT if they're just going to unsell it. So it becomes an accounting procedure as opposed to a banking procedure. So your net payable VAT at import is 0%. Now, the benefits of this are multiple for businesses, but there's no upfront VAT payment. You've got a faster customs clearance process because there's no waiting for payment from whoever's responsible for it. You've got an improved cash flow as the business shipping these goods on a DDP basis. And you're fully compliant within the Dutch tax authorities' rules and regulations. But most importantly, you've got a predictable landed cost. You know with 100% certainty that this is going to be the cost of getting my goods into Europe time and time again. So again, going back to it, what really does change is that your VAT is accounted for. So it becomes an accounting procedure. It's not something you're actually paying over. So I think we've touched on quite a few of these mistakes, but I think many businesses see that the import VAT is something that they have to pay for, but they don't necessarily always recover, and that the VAT only applies to their sales. It's important to distinguish that there are two requirements from a VAT perspective. The second is that the importer is responsible ultimately for the VAT requirements into that country. Whether it's been short paid or overpaid or not paid at all, they are the ones responsible for the VAT. Then, if you are shipping DDP without a VAT registration, your VAT is not recoverable. It's as simple as that. Paying VAT upfront necessarily is something that doesn't need to be done. And lastly, you need to have your compliance in order for this to work. You need to have all your administrative work set out and those processes laid out. Because if you don't, it makes the context of actually being able to recover your VAT that much more difficult. So now, how does handling VAT differ for B2B and B2C sales? So if we look at it on a B2B perspective, and we ask ourselves, who's the buyer? The buyer is often a VAT-registered business with a valid EU VAT number. In terms of B2C, it's a private individual, so someone with no VAT registration. So if it is a VAT-registered business, who pays the sales VAT? So Europe, again, has a very interesting concept called the reverse charge mechanism, that if two VAT-registered businesses are buying goods from each other, the VAT is effectively zero rated, the same way as it was on the deferment. Because they say if both of these businesses are buying goods for commercial purposes, why should they have to pay the money out to each other when realistically it's just going to be on-sold again? So they're minimizing the flow of unnecessary funds between companies and keeping it working within their actual bank accounts, within their businesses. From a B2C perspective, your VAT must be charged at the destination country's rate. So if we've imported goods for you via the Netherlands and you decide to sell those goods to a private individual in Portugal, you have to charge Portuguese VAT to that end consumer. Now, there are ways to account for that, and it's something that we'll touch on. But the buyer is ultimately from a B2B perspective, the one that accounts for the reverse charge in their VAT return. So what I would basically say is that if we were importing it under a foreign VAT number, you would sell those goods onto another client that's also VAT registered. You would supply them with a sales invoice that has all the correct terminology and statement applied to it. They would submit that into their VAT returns, as would you. So you would say, I've made X many sales to company B based in France, and company B in France would submit that in their tax return to say, I've bought X many items from company A with a VAT registration in the Netherlands. In a B2C perspective, the seller actually collects the VAT on behalf of the person purchasing the goods, that is the ultimate consumer, and that is when the funds must be remitted to the tax office and basically handed over. Now we speak about the context of a one-stop shop, and this is arguably most important for B2C. So you ask the question, if I'm making taxable sales in Portugal and I've got a VAT registration in the Netherlands, how does that help me? Well, basically, if you've got a one-stop shop, or more commonly referred to OSS, what that allows you to do is that you can basically signify all of your domestic sales within the European Union. So if you've made sales to someone in Poland, Italy, Portugal, France, Germany, whatever they may be, you say, I've collected all those respective taxes at that specific country's tax rate. But Dutch tax office, here is all the money. You do one singularized filing to the Dutch tax office under your one-stop shop, and then they, at a secondary layer, will then distribute those funds to all the necessary tax offices to say, Germany, John Smith made taxable sales to one of your citizens. Here's the VAT that he recovered from the sale. Here you go. So it's a very inclusive and easy structure to work within. Again, from a customs clearance structure perspective, from B2B perspective, most businesses do it on a DAP or DDP basis. And from a B2C perspective, we see many businesses employing the use of DDP or an IOSS to avoid their customers having to be the ones that incur the cost of import VAT and any form of duties that may apply. And just from an overarching compliance perspective, B2B transactions are generally a little bit easier if you've got the correct VAT registrations in place. B2C can be slightly trickier because of the multi-currency VAT rates, but again, it all comes down to your structure. If you've got the correct structure in place, managing VAT becomes seamless and easy, whether it's on a B2B perspective or a B2C perspective. So, in summary, B2B, VAT neutral when structured correctly, and the reverse charge and import VAT deferral means that you're not outlaying any cash flow in order to actually facilitate sales into Europe. It becomes as if you've got a local subsidiary in Europe without all the complexities that come with that. B2C, so VAT is a cost and a compliance driver. So the seller must charge destination VAT and manage the reporting, so either via OSS or any form of local registration. Now, this is arguably, I think, why many businesses have ultimately come here today, and that's to speak about the removal of Regime 42. So in short, Regime 42 was a structure that was allowed around a lot of businesses across Europe, and it's commonly referred to as Customs Procedure 4200 or Regime 4200, but its most colloquially used term is Regime 42. And it was initially allowed in quite a few countries in Europe, namely Belgium, Netherlands, and France, to name a few, but it was most commonly applied through France for a number of years. And it allowed businesses to defer their import VAT by using a partner's global VAT number. So practically what this meant was that if you were utilizing a freight forwarder and you were moving goods via France into Europe, you would have your own EORI, and you would act as the importer of record of your own goods into the EU, but you weren't required to have an import VAT number. What the broker would do is they would say, I'm going to take my UK client's EORI number, I'm going to link it to my global VAT number where thousands of other companies are using the same global VAT number, and I'm going to import these goods. Now, France has automatic VAT deferment on importation. So the import VAT was automatically deferred, and then the goods could then move on to their final destination. So if those goods were moving to someone in Belgium, the goods would clear via France and move on to their final destination in Belgium. However, there was a specific issue that required to be done. The broker whose global VAT number is required to submit their VAT submissions, and they have to be able they had to be able to account for that sales VAT component. That's why I wanted to start on the structure of VAT. They had to account for that sales VAT component from France to Belgium. So they are theoretically acting as the merchant of record. So they're theoretically selling the goods domestically in Europe on your behalf to the Belgian customer. Now, many of these brokers were not doing this properly. They were not submitting these filings correctly. So what that basically meant was, and again, going back to it, as the importer of record, you carry all the liability. So there was no true VAT link. So the importer never had a VAT number that could be used for the import process. So therefore, there was no direct link between the importer and the VAT declared. So therefore, when the tax office tried to account for who was paying over this import VAT or deferring this import VAT, but we weren't seeing any output or sales VAT, basically the little trail of crumbs always led back to the importer of record, and they're just saying, "Listen, I paid my broker. Like, I don't know, I don't think I've done anything wrong here." So this became a very regular issue that really started to creep up. But more importantly, it created a larger issue of unrecoverable VAT. So what was happening was that this importer of record, this UK business with their foreign EORI, was saying, "Okay, well, I've paid my broker. I don't know what you want me to do." The French tax office would say, "Well, you've deferred the VAT. You haven't shown any output sale. You have to now pay the import VAT retrospectively." So now, months after the fact of clearing these goods, in some instances even years after the fact of clearing these goods, they were now required to pay over import VAT for goods that were long sold and long forgotten about. So this created an environment where now that import VAT also was not recoverable. So this postponed payment of import VAT that was applied incorrectly because of incorrect clearance now becomes unrecoverable. So, and the third point to look at this is ultimately from an audit exposure perspective. Because a global VAT number was used, the importer was fully dependent. So the business utilizing their own EORI to act as the importer was fully dependent on third parties to correctly handle the filings and accounting. So they had no control over the matter. So in this specific scenario, they carried all the liability of any misdeclarations and errors. So, and in many ways, they were completely exposed. So, where this whole issue finally came to momentum was when, towards the middle of last year, when France said we can't actually have this anymore. The utilization of a global VAT number is no longer allowed. And if you want to import goods into France on a DDP basis and you want to be able to recover the goods, you need to have a French EORI number or a Dutch EORI number or any other European EORI number, but it needs to be linked to a VAT number held by the importer. So if you are a UK-based business and let's say you've got a French EORI number, you have to have a French VAT number that is linked to your French EORI number. This entirety of the solution is now what ultimately takes away the removal of regime 42 and now moves on to a traditional clearance method, which is something that we employ for many businesses across Europe. So, and I think it also opens up a larger discussion around VAT visibility and why it's so essential. Because the issue that many of these businesses found themselves in is that they weren't entirely sure if VAT was being incurred or not. They weren't paying it to anyone, so therefore they made the assumption that it wasn't being incurred. Whereas they did not have the detailed data per shipment. If they were in control of their own filings, they would be able to see that there was a deficit in VAT because they were making imports, they were deferring the VAT, but there was never any sales VAT filings being done. So there was just a lack of consistency in the documentation and the visibility of the documentation. But by businesses having their own VAT registration, it makes them significantly more prepared for audit readiness because they've got the ability to track all VAT exposure. They've got access to all supporting filings and documentation, and it reduces their liability from a risk perspective immensely. So I think in many ways, some of the key aspects that I would just like to touch on is that VAT is unavoidable when selling goods into Europe, whether it's from an import perspective or from a sales perspective. And although we harp on about it, Brexit did make this all more complex, but there are very good ways to overcome this. Import VAT can be a cash flow impediment, but it doesn't need to with the correct structures in place and working with the correct partners. So it can be managed, it can be deferred, and it can be recovered. So I'd be more than happy to take any questions that anyone's got at this specific point about how we can look at getting those EU deliveries faster, those landed costs facilitated faster, and also getting a fully compliant trade solution in place. I think something else just worth mentioning is something that came out quite recently was that all parcels moving into Europe from the 1st of July, and these are low value shipments, specifically shipments with a value of 150 euros or less, will be implicated with a €3. It's most likely going to be termed as a duty on their shipments. And this will be for each individual HS code that is classified on the shipment. So if you've got a shipment of 5 HS codes, and the total value of the consignment in terms of value of goods is 100 euros, you will be charged a €15 import duty fee for these low value goods. And the reason why this is being done is to combat the slew of low value shipments and e-commerce shipments in particular that are originating from the East, with a number of new marketplaces that have emerged. So as to kind of level the playing field for many European businesses, but there are also legitimate ways around this with the structures that we've spoken about by doing consolidated shipments within your own import of record and VAT registrations from the UK to the EU. That's a service that we've worked with a number of different chamber members on, and it's something that we can definitely work within. So if anyone's got any questions, please feel free to reach out to me at any time, and I'm more than happy to take any questions that might originate now. So thank you.
Thank you, Alessio. That was very insightful. Interesting to know that there is an additional duty coming up on small shipment. It's never ending nowadays. Right, okay. Thank you for the presentation. Are there any questions for Alessio? Obviously, if anyone has any particular situation, we can always put you in touch with Alessio afterwards. But yeah, if you have like any questions at the moment, you can write them in the chat. I'm gonna give a few minutes just in case we get any questions. Be quiet today. So I'll just let everyone go a bit earlier. Obviously, the recording is going to be on our website. And can we get a copy of the slides, Alessio?
Sure thing. I'll email them over to you straight away.
Perfect. So the slides will also be shared. And yeah, so thank you, Alessio, for joining us today. And thanks everyone for attending the webinar. If you have any questions, again, you have the Chamber's contact. And if you need to get in touch with Alessio, we can facilitate that for you. Thanks again for your time. And yeah, I hope you have a wonderful day.
Sorry to interrupt you. I see there is just one question from Chris.
Oh, yeah, sorry. Didn't see
He
that.
asked the question if there are certain countries that do not offer a PVA type scenario, and could you list these countries for us? So there are a number of, I would say, more countries than not do not offer a PVA type scenario. The two primary countries that do allow it are France and the Netherlands. And what we see many businesses doing is routing shipments via France or the Netherlands. And Chris, again, this is something we have structured for a number of different businesses. But if you had to try, for example, to move your goods directly into Germany, even if you had an importer of record there, you would have to pay over the import VAT. The same for Italy, the same for Austria, or Spain or Portugal. So I hope that answers your question.
Thank you. Sorry, I completely missed that. Nia says, what about Belgium?
So Belgium does not allow for indirect representation in the traditional form. There are certain limits to values in terms of how it does. It's primarily an e-commerce solution, but it's one that's fallen out of favor purely because of those blockages.
Fantastic. I hope that answers your questions, Nia. Anyone else? I think we're...
All right, fantastic. Well, thank you very much, everyone. I appreciate you all joining. And Julia, Francesco, thank you very much.
No worries. Thank you. Have a good day, everyone.
All the best.
Thank
Bye-bye.
Thanks, Alessio. Bye-bye. Take care.